Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today I want to show you how to build a complete portfolio using only 5 investments. These are built to help you diversify your money, to reduce overlap so you're not duplicating your risk, and it's something that you can hold for the long term. You can even replicate this in your 401k. So as we're doing this, I also want to mention that there are substitutes. For example, I like to talk about ITOT. That is the iShares US Total Stock Market Fund. Vanguard has a version of this. I'm sure Fidelity has a version of this. Charles Schwab has a version of this, and the returns are usually similar. Use whichever one works best for you. The concept here is how can you invest and grow your money while also protecting your wealth at the same time. And how can you do this? Well, it's more set and forget it. You come back, make sure your levels are correct, your allocation is correct every 6 months or every year. That's all you got to do with the portfolio like this. Other thing too, the results are going to vary based on where you are in your investing journey and how long you're looking to invest before you're ready to retire. So for example, you can put 40% in one fund and split the rest evenly. You can split all of them evenly, but that's going to depend on, or that is dependent on your return. So if you split everything evenly, you're going to get a different result from somebody who weighs things a bit differently. Now I did an entire breakdown for our members only, and I walked you through, or walked them through rather, unless you click the link and join, how these allocations can greatly differ and change your returns, but also how to figure out what allocation is best for you and why. That breakdown was, I think, 15 to 20 minutes long. Again, you can join by clicking the link down here to find out how you can use these 5 investments to make you a better investor based on who you are, because that's going to be the key. But let's go ahead and break down what these 5 are and why I included them. So first one, no surprise here, that's the ITOT ETF. This comprises of the total US stock market. You really want to have something like this if you don't already, especially if you're not somebody that wants to pick and choose individual stocks and read all the reports and look at all the statements and look at all the charts like I do. But this is where I have the majority of my money. My 401k, it's got a lot of money in something like this. My own IRA has a lot of money in something very similar to this. In fact, the one I have at Fidelity is ITOT, to be specific, and that's where the majority of my money is. Do I still invest in individual stocks? Yes, but the core is this particular fund. The next one is AGG, that is the US Bond Fund. The reason why people still invest in bonds is because it is supposed to be the brakes. If ITOT is the gas, if the stock market is the gas to push you further, faster, then bonds are meant to help protect you. You take on a little less risk here, and it's supposed to give you a smaller return. But again, on the downside, when the market is down, bonds are not built to lose the same amount of money. So you want to have that balance. People who are, people who are getting closer to retirement have more in bonds, and that's supposed to grow over time. I'm in my 30s, so I'm looking at 15%, maybe 20% at the most in something like AGG, where the majority of my money is going to be in something like ITOT and the rest of the funds that we'll continue to discuss. The next one is IXUS. That is an international index fund. So now you're really diversified. You have US companies, and then you got everything outside of the US, so you can take advantage of, hey, the US might be in a recession, the rest of the world may not be, which means that you get to benefit should that be the case. There are a bunch of European companies that are out there, Japanese companies that are out there, Chinese companies that are out there that can grow and help you diversify your portfolio. There is an advantage and disadvantage of a fund like this. One, diversification. One country, the US, could go down in terms of how their market is. Others could go up, so you can benefit from that. There also is a downside in that if, let's say, there's a Chinese shutdown, if Russia and Ukraine continue, if Europe shuts down or goes through a recession and the US doesn't, you could be exposed to a risk like that. I personally don't love international stocks. However, it does help to create better diversification, and in some years, international stocks do better than US stocks, so it is important to mention. If I were to allocate this, it's just me personally, I would do like 5% here. I stick with what I know. And I'm obviously a US citizen, and I bias myself towards that. I'm sorry, that's just my bias. But you do want to consider having more diversification. Test it out, see what you like about it. That one is IXUS. The next one is USRT. This is a US real estate fund. Real estate is known to be a bit more stable, pays a little bit better dividends, something you want to consider to continue to diversify yourself. And then the last one is VBR. This is a small cap index fund for the US. Now, here's the thing. ITOT, it is going to own, there's going to be some overlap between ITOT and VBR. That is common because you have all the stocks, and then in this case you have very small stocks. When we talk about, looking over the long term, 10, 15, 20 years, generally we see these small cap companies outperform large cap, but the risk versus reward here is something that you want to pay attention to. Small cap companies usually, at least in theory, have the ability to grow faster. I like to compare it to like a McDonald's and a Starbucks versus a Wendy's. Like, yes, Wendy's may or may not taste better depending on what you're into, but you don't see that many Wendy's. You can see a McDonald's in every corner in every country of the world. It feels like they're everywhere. It's hard to find a Wendy's that's relatively close to you and accessible. That's because Wendy's is more small cap. They have the ability to grow more and be on every corner, whereas McDonald's is already there. So if you are more risky and you want to attempt to grow your money more aggressively, then something like VBR is the one that you want to pay attention to. Now I'm trying to log back in and double check my notes, make sure I covered everything. But those are the 5: ITOT, AGG, IXUS, USRT, and VBR. Together, all these powers combined, you can become a diversified investor and someone that does not have to worry or check the market every single day. The key here is figuring out what your allocation is going to be. How are you going to divide your money up between each of these? I don't think the best thing is to divide it up evenly, depending on what you are trying to do. To figure that out and to learn more about how you should allocate those, again, consider the members only group, the entire breakdown on how you can see how these returns would vary and to help you figure out what might fit for you. Also, don't forget you can do this in your 401k. Most 401ks are somewhat designed to do something very similar. You can do this where you can just buy these 5 investments, invest 15%, 20%, whatever you want to do in your 401k. If you have an account on Public or Fidelity or wherever, have your money divvied up between these and say, look, I'm investing $100 a month, $200 a month, whatever it is, and take 40%, put it in X fund, and just keep rolling like that. And you don't have to worry about it because all index funds, your fees for these are going to be really, really small, and this can help you build wealth over time without the risk of investing in something like Snapchat that fell pretty bad this week. And that's not a referendum on Snapchat, even though I'm not an investor of it. But that's the thing. I don't have to risk doing something like this. I can look back and say, look, I own all these companies. I own real estate. I've got bonds. I've got all these things. I don't have to worry about choosing the right stock every single time. So if you're somebody that wants to sit back and relax and put your money on autopilot, these are the 5 ETFs for you. If you want that more detailed breakdown, you want to make sure you're in the members only, and that link is right here and in the description below. All right, it is taco time because it's Friday. I'll talk to y'all later.